Welcome to Target Market Insights, the multifamily and marketing podcast. Each week, John Kasman interviews multifamily and marketing experts to teach you how to find the best places to invest, attract investors, and grow your portfolio. You are listening to Target Market Insights with your host, John Kasman.
Everyone, thank you for joining us. This is kind of the second installment of our webinar series we're doing for the Midwest Real Estate Networking Summit. Obviously, when we first set up this conversation, we were really focusing on COVID. There's been a lot more change in the world since then. Let's start really just by introducing ourselves, and then we'll jump into the discussion just to save some time. Tony, why don't we start with you? Can you give the people a little bit more background of who you are and what you do?
Hey, why don't you come back to me? Because I had an idea to do this in the yard, and somebody started cutting the grass right now.
I don't know why you thought that was a good idea, but okay. All right. I guess when you're in Chicago, you have to take advantage of any sunshine you get. So, Dan, why don't we start with you?
Sure. So we're talking about backgrounds, right? Now I'm like confused as to what we're talking about now.
Yes. Introducing yourself.
Sure. My name is Dan Handford. I'm one of the managing partners with a multifamily syndication group, a private equity real estate firm called PassiveInvesting.com. We don't use any institutional equity. We use everyday investors just like yourself to acquire large apartment communities. And we've been acquiring actively, even in the middle of COVID-19. Just a couple weeks ago, closed like John said earlier, a $50 million deal out of Charlotte, North Carolina. And then less than 6 months ago, closed another $51.5 million deal out of Raleigh, and continuing to kind of grow and expand in the Carolinas, because I'm located here in Columbia, South Carolina, and acquiring properties in the North and South Carolina side. We do have some acquisitions in Texas and Tennessee, but really the last couple of years been focusing really heavily in the Carolinas here, and looking forward to continue to expand. I also have another group called the Multifamily Investor Nation, which is a group of about 26,000 members now of people that are learning about multifamily investing. And then as far as my background, prior to even getting into this, I got into multifamily because of the tax benefits. So I was making some decent revenues and cash off of the clinics. I have a group of non-surgical orthopedic medical clinics that I own here in South Carolina, and was having to pay a lot of money in taxes. And to be able to reduce that taxable liability, started investing into real estate, and ended up creating this syndication firm, which is where we are today. So I'll turn it over to Matt, let you give your introduction now too.
Well, I do want to know something with Dan here. I want to know what crazy antics Dan is going to pull, because Dan, I've been on several panels with Dan, and he's always been like blown my mind at the creativity and the off the wall stuff that Dan has put together. I was at a conference.
That's usually at the live events, though.
Hey, we can't do live right now, man. Come on, I want to see something cool. Come on, where's the high school marching band that's going to walk in? Right? Yeah.
Doing it shirtless.
I was at an event with Dan in Dallas, and he talked about getting noticed, and all of a sudden he just snaps his fingers, and the local high school marching band, like 30 kids with drums and instruments, all came in the room that Dan had orchestrated. Nobody knew this was going to happen except for Dan.
That was a lot of fun.
Yeah, and he's pulled a lot of cool stuff like that before. So if you ever get a chance to speak at an event or be at an event that Dan is going to be at, Dan, I'm setting the bar right now. Dan will always exceed your expectations on stage. So
thanks for that, Matt.
So I'm Matt Faircloth. My company's called the DeRosa Group. We just help people put capital to work in real estate that don't want to do it themselves. They want to just invest passively and make the great returns that real estate can offer without dealing with the headaches that real estate can offer as well. We'll take the headaches and that. And we've built a solid network of passive investors. We've been involved in all kinds of neat stuff. From new construction to probably 4 or 5 dozen fix and flips to just under 1,000 units of multifamily, and that invested in the Carolinas as well. As Dan is also invested in Kentucky, of all places, and also invested in Pennsylvania and New Jersey in multifamily. So really learned the equation on mating and putting together passive investors that really want to go hands off. With deals and finding what deals, because there's not one deal that suits all investors, and I find that not all investors want to deal with the multifamily assets. So what we've been good at is pairing investors with pairing investors and their calibration for risk with the right deals. Authored a book for biggerpockets.com called Raising Private Capital, which is it's an Amazon bestseller now, and it is a book that really teaches people how to reach into their own personal network and find the money they need for their deals. So yet again, Dan, not exceeding exceeding expectations by pulling in the multiple camera angle. Who saw that coming? I didn't see that coming. I didn't see Dan coming in from the right hand side. He did, but I didn't. So anyway, with that, I'll defer to the next to our new friend here.
Thanks, Matt. Tony.
All right. So I'm Tony Hardy. I'm a commercial real estate broker over at Marcus Millichamp, specializing in multifamily. Our team covers the Midwest, the Midwestern states. About 80% of our action, 80% of our action is Chicagoland. That's where a lot of the action is. Also work as an advocate here for a lot of the property owners in the city of Chicago with the Neighborhood Building Owners Alliance and the Southside Community Investors Association and the Commercial Forum, which is a member of is the largest group of commercial practitioners in Chicago. It's a division of the Chicago Association of Realtors that deals specifically with commercial and what I like to call residential practitioners. And we're dealing with a lot of the policy initiatives that are coming down the pipe. Last couple of days, we've been dealing with cleanup as a result of a lot of the aftermath from the protests. And we recently started a community called the 77. There are 77 neighborhoods in Chicago. And through CAR, we're able to raise, and I'll send a link to John later, where we're able to raise money so that we can be boots on the ground with different realtors in different neighborhoods, helping to board up and helping to clean up some of the businesses that were impacted by the thing. Recently started a web page, Deal Junkie, which was an events company. We were doing a lot of live events, bringing in the resources from around the Midwest, the syndicators, the banks and lenders, along with the investors and the brokers and the appliance companies to try to get everybody in the room with the resources. Well, events kind of shut down. We had a big event in January with over 300 people. So we've been doing a lot of virtual events, and we started deal-junkie.com, which attempts to continue to operate in that space and bringing everybody together. So that's my background.
Thank you, Tony.
I'm doing now. It's like the last week.
Thank you, Tony. Appreciate the context. And guys, thank you for just giving a little bit more of your background. So let's start with COVID, right? I mean, that's really the biggest thing that everyone is dealing with. Matt, I want to start with you. You and I had a chance to talk right as this thing was beginning, right there in March. I believe it was kind of late March before April hit. And we had a pretty good conversation about the impact, what to expect. Now that we've seen, it's here in early June now, we've seen what rent collections look like for April. We saw what it looked like for May. By all accounts that I've seen thus far, it's on a similar track for the month of June. I want to understand, how has COVID actually impacted your current portfolio? And then what changes are you making to your underwriting as you look forward?
Good question. I remember that day. And it was right when it was going down. And I was like, hey, John, when's this going to get broadcast? And you're like, oh, like a month or two. And I was like, hey, listen, how about you want to talk about COVID, like about now, and you put it in the front of the line to give people something to listen to? Because that was just back when we were just trying to figure things out. I mean, we're a long ways away from then, because we just weren't sure what was going to happen for April, if I recall. So where we are now, we quickly, I felt sorry for ourselves as landlords for probably a day or two, and then got into action and started to try to do what we could do to get ahead of it. And that meant that, folks that were looking for places to live still needed to look to place to live. Maybe they had leases ending, or maybe they were living with family in tighter quarters, and due to safety and social distancing needed to move. And so what we did was we created initiatives for social distancing approved showings at all of our properties. Virtual showings, and doing a lot of Instagram posts and things like that, Instagram level tours and property tours digitally, Rently boxes and things like that. So we did a lot of that. And I think that, let's say I have a property in North Carolina Carolina in Fayetteville that went up. I think we signed 20 leases in the last 2 months, which normally were a lot less than that. So it's a big turn. So we were at 60% occupancy, not afraid to say that, when COVID came around, and we're at 74 now. And so we've seen increases in all of our leasing, all of our properties, everything I own, in North Carolina, Kentucky, Pennsylvania, everything, all the lease rates have gone up because we've gone 100% social distancing on the showings, and other leasing offices just shut down and just kind of waited for this thing to blow over, whatever that means. In that, on collections, some of our properties are doing great, are doing better than they were pre-COVID. Some properties are not. But because we've been able to push leasing and to try and attract folks looking to move, we've been able to cover up any income issues that we've had at properties by new rents coming in for new folks looking to move into the property. So all in, revenue's up across the board, because we got proactive and just reached out and tried to predict the new normal here. And, I think we were able to do it. With regards to your second question about our underwriting, we're still under contract. Dan, you and I was picking your brain a couple months ago about a deal we had in South Carolina. I'm still under contract on that one, and I keep deferring closing because that seller, has not been able to bring their rent. They're still facing major collection issues in that. So I think that to answer your question, John, we're just expecting higher delinquency, higher collections on properties when we underwrite. So we're still looking, we're still active. I think it's awesome to hear what Dan's up to. He's guys making it rain out there. So I think we are still looking at deals, but I just think that we're much more conservative on the revenue side. Not so much on expenses, but on the revenue side, we're much more conservative when we evaluate deals. And I'm not predicting any rent bumps when I look at deals. I'm not looking at major, the days of value adding and doing a reno to get $150, $200 a month in rent. I'm not going to be predicting that if in the foreseeable future. Other folks may have different opinions on that one, but I'm not looking at big rent increases anytime soon.
No, great. Appreciate that. Dan, similar question. You mentioned that you closed a couple of deals, both leading into COVID, during COVID. I know you're still actively looking. How did you make adjustments to your underwriting as you were looking at COVID and the impact it was going to have on your portfolio? We didn't. We just maintained, Just teasing there. Well, interestingly enough, the deal we just closed in May, we actually put under contract a week before COVID, really kind of the full impact started to be seen, all the shutdowns. It was like the first week of March that we got it under contract. And then the next week is when everything started to really shut down. And so thankfully, this particular deal that we were working with that we closed it was a Class A deal. So it's a suburban Class A. Average rent's $1,300 a month. Average income of the residents there was $84,000 a year. So it's a very good, solid, stable asset. And it had really high occupancy, 97.5% occupancy. And so it was already a strong asset going into COVID. And we continued to monitor the collections while we were in it. And we had to, the nice thing about this one is, because it was one of the biggest questions our investors had for us was, well, if there's so many other deals that are falling out, why are you still moving forward with this deal, right? And it's because most of these other deals that were falling out were using a different type of debt structure, like a bridge loan or something like that, where that bridge lender pulled out at the last minute and they couldn't get new financing, or they were underwriting for renovations and rent bumps like Matt was saying earlier. And right now, I agree with Matt. Like I don't see I see flat rent growth for probably at least the next 6 to 12 months, maybe even longer. But I think at least for the next 6 to 12 months, I think we're going to see some flattening of the rent growth. And so obviously, certain markets will fare better than others. But one of the things I do think that we're going to start to see is we're going to start to see a move and a shift from urban style living to more suburban style living. And so you're going to start to see that there's going to be even more demand for multifamily in the suburban areas than what it was before.
more. And so there might be that's going to be an interesting kind of thing to kind of watch to see if the obviously the urban style is, if everybody's migrating out from that, you're going to see that start to have decrease in rent growth, which will maybe even balance out some of the rent growth you're going to see in some of the higher rent growth in some of the suburban markets. And I think that's going to probably happen over the next probably 1 to 3 years. You're going to start to see that migration out. And then, of course, what I think is going to happen after that is you're going to have probably another 1 to 3 years after that of a migration of a different type of population coming back into the urban areas. So you're going to have this kind of ebbing and flowing over the next probably 3 to 6 years when it comes to that. But as far as on the deal that we did, and that was one of the things that we did is we didn't have any really high rent growth assumptions. I mean, we projected to raise the rents like $9 a month or $9 across the board in all of our units. And it was like less than 1%. It was like 0.7% or something like that it ended up being on the effective rent growth for the first 12 months. So there really wasn't a major increase in the rents. And it's a Class A deal, so we're not trying to like do a value add. So there was no issues with the renovation timelines or raising the rents and things like that. So it was almost like a perfect deal for this environment. And once the investors kind of understood that, it started to make sense to them. And, you know, we acquired that property with a lot of investors. Like, we don't just have one investor. We got over 250 investors in that deal, you know? And so we had a lot of people that, you know, were able to invest in other properties because they were falling out. And so they were able to move into this type of an asset. But we also looked at the vacancies during this property that we acquired had a historic vacancy. I mean, historic occupancy of about 96 to 97% since 2014 when it was built and put online. And we had originally underwrote it with a 5% vacancy just to be safe. And then, of course, COVID hit. And so we adjusted that to have a higher vacancy right now during COVID as well, which I think was the smart thing to do because you never know what's going to happen. But we've also been able to sign leases just like Matt has seen. We're not seeing a decrease in traffic. It's actually started to pick up a little bit, even higher than it was before COVID. So it's actually been a good thing. And so I think that, you know, even with the collection side of things, the property continued to maintain almost 99% plus collected for the months of April and May. And June is starting to be that same way too. Right now, obviously it's the 4th of the month. The rents aren't due until the 5th. So that's tomorrow. So we'll know for some more data, probably the Monday or Tuesday next week.
It's interesting to hear you guys say that. Go ahead,
John.
Matt.
I have a question for Dan because I think that it just ties into financing because everything, you know, post-COVID, John, as you and I know, you know, agencies kind of changed their game up a lot. Did you close that deal with agency debt?
We did. It was a Freddie Mac.
How did the changing of their terms affect your deal? Because I know there are all these escrows and stuff like that. Did that change up your underwriting, change your deal and all? Because I know that's been a big question mark of mine.
One of the things that we've always done in our projects is tried to overcapitalize them so we have plenty of operating reserves. And so on this deal, even on day one when we were closing, we're going to have $1.2 million in operating reserves as a safe fund there. So we already had planned to have excess. And so yes, did we have to dip into that in the short term to put up some operating reserves? Yes, we had to put 9 months of reserves up for the deal. They wanted 12, but we negotiated 9 because it was a great solid deal. You know, had great collections even in the middle of the pandemic. Okay. But they were easy to work with, and we were able to get it done. So, but they did require us to have those interest reserves, and but we got a really good fixed low rate, higher than what we had originally projected, which is one of the reasons why we actually retraded on that deal. And it was the very first deal that we had ever retraded on. But we had originally underwrote the deal at 3.2% interest, and we were getting term sheets at that time before COVID, and maybe some of you remember some of these term sheets, but we were getting term sheets at like 2.8%. I mean, it was like phenomenal debt, and so we didn't want to underwrite at 2.8, thankfully, right? So we underwrote it at 3.2. Well, interest rates were inching up above 4. You know, in the middle of the whole COVID-19 stuff. And so we had to go back to the seller and say, hey, we have to negotiate a lower price because we have to maintain the same level of investor returns that we're projecting. So we need to see if we can get a lower price. And they worked with us and we were able to get a lower price and, came to an agreement and we're able to get it done.
Awesome.
That's
Thanks
amazing.
for asking.
Yeah, appreciate that. Hey, and real quick, I realized I didn't really introduce myself. We got to just jump right into everything. So
I was wondering, John, I was about to turn it.
Who's this guy?
Who is this guy talking? So my name is John Kasman, and I'm one of the co-hosts and co-creator of the Midwest Real Estate Networking Summit. I also host the Target Market Insights Multifamily and Marketing podcast, and I'm a multifamily investor as well. I partner with other people, very similar to what Matt does, what Dan does, and we kind of pull our resources together to go go out and buy properties. And one thing that I've seen right now is, there from a lender standpoint, we're seeing a lot of fluctuation. I think there was a lot of uncertainty when COVID first hit. You talked about they wanted 12 months of interest reserves. You were able to negotiate them down to 9 months. And we're actually, in the middle of a couple deals right now, and that's come down to 6 months, and it could potentially be 3 months, a few weeks from now, we don't know. But there's a lot of flexibility and a lot of changes there. You talk about the lending side of it. I know CMBS has pretty much, changed and shut up or shut doors for a little bit as far as what they're doing. A lot of the bridge lenders have kind of disappeared or tabled their offerings and jacked up their interest rates. So there's a lot of fluidity right now from a lending perspective. Tony, as a broker, someone whose job is to really make sure the deal gets done, working with those sellers, working with those buyers, how are you seeing kind of the landscape right now as far as pairing sellers with buyers, especially given the fact that lending is kind of all over the place right now? Tony, you might have went on mute.
Am I back?
There you go.
Yeah. All right. Yeah, you're right. That's a great question. I've been on the phone with buyers and sellers constantly, a lot of Zoom meetings, and the thing is helping to manage a lot of the short-term pain and get them back focused on the long-term perspective, because these guys aren't fixers and flippers, right? We bought this. We're looking at a 3, 5, 7 year horizon on these properties, sometimes longer. And when we look at, and it's just doing that, talking about deals closing. We've been, the last deal we closed was a 196 unit single housing portfolio in Chicagoland. Believe it or not, those things I've been running from for years. These guys call me with these massive housing, single families and 2 flats. And I'm like, no, but we looking at the landscape, like you guys are talking about, people moving to the suburbs with COVID. I think Chase just partnered up with Blackstone or Sam Zell to create a fund for single family. The millennials, the biggest driver in multifamily, the millennials. All right, 77 million, 60% of them are 29 and older now. They're getting married, and they're already moving to the suburbs. With COVID, the urban centers, right? We're thinking there's going to be a little bit more of that. So it's just trying to be as far as lending. We've seen it from lenders just jump out, right, and deals falling apart the first week, shut down, and until other lenders stepping up and saying, hey, we see an opportunity over there. So we've been seeing improvement as far as in lending, and just trying to harness that and be able to present it to the owners. I just got off a phone with an owner with a big portfolio in Hyde Park, and he's like, I don't know what this is going to do to the market. He's like going crazy. They looted the Benny's on 47th Street or whatever. And I'm like, look, this didn't just happen in a vacuum on the south side of Chicago. This didn't just happen to you. This happened in 30 cities around the country, right? So if they're going to pull out of Chicago, they're going to pull out of the U.S. So don't worry about it, right? Worry about it, but it's not, right? And then when we look at talking to the buyers, I got the bottom feeders, right? They're looking for blood. They're calling from all over, right? Trying to get in on deals. And we're like, okay, the deal, well, we've seen some REIT where their stock value declined by 30%. Yeah, they were heavily vested in senior housing. Okay, I'm aware of that. Let's look at what's happening. The 10-year treasury is at 0.7 right now, right? You're a buyer in January. The Fed fund rate, we're at a 2.5, right? So effectively, a 6.5 cap today, right, was a 7 cap. Was a 6.5 cap today is a 7 cap. When you look at your cash on cash return, and you would have bought that deal all day at a 6.25 in January. So let's look at this, and let's look at what's in front of us. Right, we're looking at the millennials. They're going to be renters. We think as a result of COVID, they're probably going to be there's employment loss. There's this, that, and the other. Our pipeline is still strong in multifamily, right? There's a lot of 1031 money on the side. We're talking to guys. They extended the deadline by 30 days. So I'm talking to buyers about that. Hey, what are we going to do? There's $8.1 billion. There's a lot of money in 1031 exchange out there, dry powder already over there. Restaurants took a hit, but look, restaurants with drive-thrus and fast foods, they're doing extremely well right now, right? And what are you going to do? Now we know we got something that's COVID proof, and you can't Amazon box a restaurant like with a drive-through. Dunkin' Donuts is still building stores, right? And we're just trying to get a grasp on it, harness the energy, and we're getting deals over the finish line. We had to reroute some, but we're also seeing, like you're saying, the agency debt. And some of these lenders that really got skittish in the beginning are coming back and saying, okay, we don't need 18 months. We can live with 12 months or 9 months or 6 months. And things aren't there. And everybody's like, oh, nobody's going to pay rent, right? Now we got a national study 2 months in a row. We're 96% collected nationwide. Chicago's collected. So the bark was bigger than the bite in some instances. Right. And we got to deal with the reality. And that's what I've been doing, a lot of mitigation and trying to talk people off the ledge. Because if you're trying to put the property on the market right now, what are you thinking? Let's talk through this. Right. And some properties, depending on what it is, where the debt is and what they're doing, we are listing them. But other ones we're saying, hey, let's just hit the pause button. Let's look in 60 days. Same thing, lenders, right? And that's the biggest driver. The last, and everybody's talking about 08. 08, it took 13 months before TARP happened, right? And it was 6% of GDP, right? Already in 6 weeks, we got 30% of GDP in stimulus. So there's some factors here that we need to look at. But yeah, COVID has affected my business, but it's been more of a forward looking and trying to deal with is blow by blow. I mean, we're looking at some deals fell apart, some deals are rerouted. That's where we are with deals.
So let's talk about the outlook, because you all had said a few things that I think really jump out to me. First of all, Matt, you talked about the way you're underwriting deals right now, really focusing on more delinquency right now, more bad debt, and just recognizing that rent growth is probably going to be zero for the next year. Dan, I know you are still doing deals. You're actively looking for opportunities, and you're focusing on more Class A stuff that is, not really value add, and really stuff that was already, at an institutional quality. And, as you were talking, Tony, part of what jumped out to me is finding ways to continue to do deals and analyze where we're at in the cycle. So I have to ask a question. Does value add still make sense right now? I think as people are looking to do deals, obviously there's going to be some deals that pencil no matter what's going on in the marketplace. But as a strategy, value add being one of the hot popular strategies for multifamily investing, does it still make sense given everything that's going on? Tony, I want to start with you.
Absolutely. Yeah, value add makes sense. And there's going to be even more value add opportunities. And also in retail, some of these stores that got broke down, some guys are going to take their insurance money and not come back, right? But it'll create opportunities for other people, right? So I think that value add is definitely on the menu, and it'll remain so. But trying, like you said, trying to price in huge rent increases and I'm going to take this from affordable to luxury and these kind of things. I think you do need to pull back the harness a little bit on your valuations. But when you look at the fundamentals, we're there. The largest driver is still here, and that's population, right? The population drives multifamily and retail. And everything goes on. Yeah, the way we're doing business, what we're doing right now is a little bit differently than we would have been doing it probably if 6 months ago. So that'll change. But I think value add opportunities are abound, and a lot of that. I'm starting to see those buyers saying, "Hey, I don't wait till later. I want to start analyzing some of these deals now. I want to jump in now. I don't want to wait until I'm competing with 99 other people that's waiting to see what happens."
Yep. Matt, what's your take?
So I think value add is always going to be a play. I mean, that's how you make, in a lot of ways, it's kind of how you make money in real estate. You invest this, but increase the value by this. It's the beauty of forced appreciation, right? But I think that the game is going to change. As Tony said, you're going to have properties that maybe were unfortunately dilapidated or damaged during riots or whatever, that are opportunities. But also, I think that you've got properties that are owned by tired owners. I think that I can probably say 60 to 70% of what I've bought in my 15 years of careers have been from tired owners, right? Currently you got baby boomer tired owners right now. And COVID, to some of the baby boomers I've talked to that own real estate, this is like the straw that broke it. It's like, you know what? This is it. And I've dealt with a lot of mom and pop sellers and I think that is an opportunity in value add to go and find somebody like that who's running property, and operating them below where other properties are around them. So there could be a property where somebody's getting $500 a month for a 1-bedroom that hasn't been touched in 20 years, right? Maybe it's still got, the old school yellow refrigerator and stuff like that going on, and they need a big facelift. That could be a value add play, even if the market is here. That property could be down here in rents, and you could bring it up. Maybe not bring it all the way up, and maybe you're a little bit below the median. I don't think that we're going to see people pushing median rents up in markets. But so I think that if you've got a deal that that's below the median rents in the market, then there's a value add play there. Additionally, big value add can be made, I think, in real estate in we've been playing on increasing revenue in value add. Almost everybody's been talking about that. The new value add game that people are going to be able to do is reducing expenses. So if you can step into a property, reduce utilities, reduce lighting expenses, reduce water consumption, reduce management expenses, not by just laying people off, but maybe by just, better utilizing the folks that work at the property, maybe by, utilizing them at a few different sites or something like that. Other ways to reduce the expense profile of properties, I think, is going to be a good value add, because at the end of the day, all value add really is increasing the NOI of a property and then forcing the appreciation up so that you can refi and recapitalize, make more money for everybody that way. So yes, it does exist, but I think the equation is going to change.
No, great answer. Dan, for you, you talked about a deal where you're projecting rent growth at $9 a year, basically. How in the world are you creating that kind of value for your investors with just a $9 increase?
Well, $9 is $9, right?
Times 3,000 units, right?
Yeah. Well, I think, to kind of dovetail what Tony and Matt said, yes, I do feel like there's still value add deals that can be made right now, and that value add's not going to go away. But, I don't want to repeat what you guys have already said, because it's some of the same ammo that I would mention as well. But I think you also have to go look at and see, why is multifamily value add still going to be there? And it's because of the demand. So pre-COVID, the demand for multifamily was pretty high. Well, in the middle of COVID, guess what? I think it's also going to cause it to continue to increase in demand. And so even though, I know we've all kind of talked about how the rent growth is going to be flat for the next, year pretty much. I hope it doesn't. Because if you look at all the demand drivers, it doesn't support that. It just truly doesn't support it. I think that's what's going to happen. But if you look at the demand drivers, like right now, we already talked about that, in the demand for suburban multifamily is going to go up, because you have the urban lifestyle that people are going to be driving out of that because of the COVID-19 into these suburban areas. So the suburban multifamily value add, I think, is going to be really where you want to be looking for these assets and these value plays, because that's really going to be where you're going to be able to go in there, do those renovations. And because there's so much demand, it's going to allow you to be able to increase the rents even over the next 12 months. And then the second reason why multifamily is also been continuing to increase, especially in COVID, is that all these residential mortgage lenders have tightened up their criteria for lending, and they're not lending on the terms like they used to before. So it's harder and harder for people to actually qualify for loans. And so all that does is just force more people into the rental market, into that multifamily market, and it causes an increase in demand. And then, of course, if you look at all the pandemics in the last 100 years, what are three things that are always come out of it? You have increase in marriages, increase in divorces, and corona babies, right? They're not always called corona babies, but you're going to have babies because people have been in their house for 2 months, right? So come January and February of next year, we're going to see this increase in the population because of those new births. And all that's going to do is just continue to drive the values for multifamily and drive the demand for it. So that's why I say, I still think it's going to probably be flat over the next 12 months, but if you look at all those demand drivers, I talked about 5 of them just right there. All of those are going to increase demand, and when you have increased demand, guess what happens? You still have the same amount of supply, or maybe a little bit more supply, but the demand is going to continue to outweigh the supply that's coming online, and it's going to continue to drive the values.
Yeah, and we're seeing something similar in our portfolio right now where, in our Midwest properties in particular, we've got a property in Cincinnati that is not that far from Xavier University. And we're actually able to start attracting residents or students from Xavier, whereas, last year we didn't have any residents that were students at Xavier. And part of what we talked to our property manager about is, with the quality of the product that we have and the value that is perceived at that unit, people are looking to save money. So they don't necessarily want to downgrade the kind of apartment that they live in or the kind of housing that they're in, but they are willing to move to a slightly different neighborhood to get a similar quality asset. So that's something, as you think about value add, where are you at? Where's the location? And who can you attract from a tenant standpoint? That could be another great way to do it. The other thing you guys talked about was really about where there's opportunity, where the data is. And the data says that even though I think we're all kind of taking a similar approach of being conservative, underwriting to zero rent growth for year one and things like that, the demand seems to be picking up. We're certainly getting some more applications and getting some more interest. The question really comes down to investors, and I think it's the $1 million question, is should investors get in the game right now, or should they continue to sit on the sideline? What do you guys think? Dan, I'll start with you.
Yeah, I was going to say, I can definitely take this one because I've been dealing with this with our investors over the last, 60 days of, that's one of the main reasons why an investor, decided to not invest in our project is because they're like, hey, I want to sit on my capital because I think, and Tony touched on this a little bit earlier, I think there's going to be phenomenal, blood in the water deals in the next, 6 to 12 months. And, I just don't think that's going to happen. I mean, I think that what you're going to see is you're going to probably see some deals where, like Matt mentioned, these frustrated kind of mom and pops that are just like ready to be done with their property. And so I think you're going to see some discounts. I think a lot of people are looking for the 08, 20, 30, 40% discounts. Yeah. And I don't think we're going to see that. I think we're going to probably realistically see between about a, 5 to 7% discount, average all across these properties. So it's not going to be a really significant amount. There will be some discounts, but I think right now people should look at the deals that are out there and make an educated decision, because someone who has maybe say $200,000 to invest right now versus somebody who has $2 million, there's a difference and there's a different conversation that each one of those people have to have as to the amount of money they want to put in a different particular type of opportunity and things like that.
Matt, what's your thoughts?
Yeah, well, okay. It depends on what kind of investor we're talking about. I mean, to agree with Dan, I wrote an article for Bigger Pockets about this last week about how, a lot of people are like, oh, so when am I going to get good deals now? Like, okay, 2008 is going to happen again now, right? So everything's going to get cut in half and I'm going to get to go out there and scoop up lots of good deals. Now, people don't understand. I was investing during 2008. And that, first of all, that was not, people think it's a fun time would have been a great time to be investing. No, that time was awful because lending dried up. Lending is not dried up at this time. So this is an income crisis, not a debt crisis. This is a whole different crisis, a whole different scenario. In that you got to learn to play the cards now in today's market. So I think that if you're an active operator, like the four of us are, then you've just got to learn the way to play the market as it's going to change. Again, look for changes in income. As I'd said, look for changes in income on property, and then look how that's going to trickle down to property prices, right? So if you're active and you're going to do it that way, great. If you are a passive investor, I would look to just, instead of like trying to scoop up the best deal you can, invest more for capital preservation and invest with folks that are good horses to bet on, that are going to preserve your capital the best way, that are not going to try and pass down a bunch of risk down to their investors, that are going to at the most pay a good return, maybe not invest in a deal that shows that the syndicator shows you're going to get a 35% IRR on Crowd Street or something like that. Maybe that deal is not the one to go for right now. Maybe invest with a syndicator that's going to give you a 12% IRR, but there's way better capital preservation there. So I think that yes, now's a good time to get in, but just understand what you're getting into. But I don't believe that folks that sit on their cash and wait for a crash or wait for things to change, I don't think they're going to be rewarded. I don't think there's going to be a major shift in anything these days.
Tony?
Yeah, I was just looking at agency debt, right, and unpaid principal balance for Fannie and Freddie. Right now, both of them are less than 3%. I think 2.6%, 1.6%. So somebody waiting on just a big myriad of foreclosures to hit the market in the multifamily space, there's always some, right, in any time. Maybe there'll be a couple more. But I think that I got a deal on a smaller apartment building under contract now that we're purchasing. And the fact that we're in the game gives us the opportunity. Now they aren't doing so well with collections, right? And they're negative $25,000 or something like that for last month, and we think this month will probably be a little bit worse. But we got a little extension. We say, hey, we need to hit the pause button here. We need to kind of see what's going on and move forward. But that's a totally different. So and because we're in that situation, we can ride the wave and we'll be there to benefit. But if you're just waiting on the sidelines, it was a lot of dry powder already on the sidelines. Who are you going to be going against?
Get in line.
It's like the institutions have hit the pause button, and a lot of our private clients are stepping up to say, hey, I was getting my tail kicked in that space right there. I couldn't touch a $40 million deal or $60 million deal because these guys were taking that immediately, or I'm committed with a billionaire that's thinking about his grandchildren. I'm trying to buy this deal for now. So now that created an opportunity. It's the same thing when some of the lenders step back. Some of the lenders said, no, we're not. We're done. We're throwing in the towel. Other lenders jumped up. Now those guys are coming back saying, hey, we're lending again. Oh, sorry. Like we weren't waiting on you, right? So I think the opportunity is here now, and you won't be able to. And if there is a shift, a huge shift in 3 months or 6 months, you wouldn't be in a position to even appreciate it because you didn't see what was going on right now. So I'd say yes. Get in the game. What is it? Get in the game now. Yes. And the leverage is still there. It's not a financial crisis, right? The debt is still there. The Feds. I was talking to Merrill Lynch, and we were looking at what happened and what's going on in the different markets around the country. And the Feds came in. We saw a huge dip in U.S. and worldwide, and then a very sharp incline. I'm like, was that the stimulus? I said, no, it was the Feds. They stepped in and they started purchasing debt. They started backing the financial institutions in the country, and it made a huge impact already. So if we're waiting on the bottom to drop off before we do something, you're going to miss a cycle too. You're going to miss a whole cycle.
There's people that have missed the last four years of that stopped investing in 2016 because they started sitting on their hands waiting on the real estate market to crash because we were air quote due in 2016, right? Yep. Yeah. Waiting does nothing for you. I read a book for my son. He's 6 called "Oh, the Places You'll Go," and it talks about an awful place you never want to go in life, which is called the waiting place. It just life is not going to sit and wait for you to wait. Right? Find a way to make it work now. The banks don't want these properties back, so you're not going to have blood in the streets. You're going to have banks trying to work it out. They don't want to have a wait happen again. That's why they're doing deferments and workouts and stuff like that. They want to help owners, and I hope that nobody loses their property, that we all work together and work it out. And you find these tired owners who have made their mint. Maybe they own it free and clear or whatever. Find a way to buy it from them instead of hoping that somebody like one of the 4 of us loses one of our deals to a bank taking it back. I shame on people that are out there rubbing their hands together, hoping for things to crash, man. That's somebody's business plan and the family they're feeding falling apart for that to happen. Thank you very much.
Those guys lose every time. I remember calling them in 09 and 10 and 11. I'm like, hey, you still waiting? The market's going up. And they're like, Tony, the market's not going up. We're just bouncing along the bottom. I'm like, I'm done with you.
You don't know. Right.
I think that's the point too, right? About getting in the game, because the problem is you don't know when the game goes up unless you're in it every day, right? Unless you're really active, looking at deals and kind of starting to watch the trends take place. You're not going to know when it is time to take that shot. And I love the point you guys made about the fundamentals of multifamily still being fairly strong. And as I think the 4 of us are pretty optimistic that multifamily is still a good investment right now. now. So I do want to take a bit of a contrarian viewpoint or ask some questions there. But the one thing that you guys said about the fundamentals is that lenders are still lending. They don't want these properties back, unlike in 08 where they just foreclosed on you. And most people are making their rent payments. With residents making their rent payments, owners are making their mortgage payments. So we're not seeing anything that indicates 6 months from now, there will be properties that are being foreclosed on or people who are looking to get out of their deals, with the exception of maybe some of these burned out owners that may be boomers, that may be a little bit older, that are ready to unload some of these properties. That may be a great opportunity, but to expect for, prices to drop 20%, that may or may not happen, right? And there's nothing that we see here that indicates that's going to happen. If you're waiting for that, you may be waiting a long time.
You might see that more in the urban areas.
You may.
That's going to be temporary though too. After this, hopefully these riots end soon, that'll be temporary. But yeah, you never know. I think that hopefully that urban America comes back and that we stabilize. I own a lot of urban properties as well. I love my urban stuff. There's just a lot of character to them and everything. And they in an up economies, urban America does really, really well. So could be. And I agree with your point, Dan, that the burbs are going to pick up as people kind of flee that area just for a little more space, a little more perceived safety, whatever it is. So maybe that's a play. I don't know.
So I've got one more question, then we're going to open up to Q&A from the audience here. But to play a little bit of a contrarian right here, one of the fundamentals that isn't as strong and is not as optimistic is jobs. We are facing kind of unprecedented job loss right now with the economy. It's still really hard to gauge where exactly we're at today. But with so many people who are losing their jobs, at some point the stimulus money is going to run out, or maybe there needs to be another round of stimulus package. With unemployment at some point going to run out for some of these people, how are you looking at the job loss as an impact when it comes to investing? And I'll start that with you, Matt, just since you're on the screen.
Well, let's look at, not to get into real politics or whatever, but they're going to keep printing money into November, so we're going to keep, I think we'll see the unemployment benefit, the $600 bump that came out on unemployment. We're going to see that get extended because nobody's going to want to see what's going to happen if they take that away. Right. So I think that you're going to see, for now, we're going to be propped up. The income will continue to come to consumers and to those that unfortunately lost their jobs I believe in the November. And then who's to say? I think all bets are off at that point, right? As multifamily owners, I think that we have just a simple solution, and that's to just stick to our underwriting guidelines when we underwrite tenants, because tenants get, credit checks and things like that. So it maybe entails adjusting it, but it might just entail that you might have to decline a few more applications and do a heavier marketing program to attract tenants that are are financially more stable and everything like that. So I hate to say it, I'm not trying to be cold by saying this, because you do have to treat it like a business, because I know these are humans that you're putting in properties and everything like that. So I'm not trying to overlook that or talk about putting people out on the street. But at the end of the day, I do think that if you look at it just from the business side, you're probably going to end up declining more applications than you used to, based on income and based on those kinds of things. Now, I think that it's yet to be seen what Washington's going to do with regards, because they know that they're going to have a major. This is like the largest amount of people filing for unemployment in a collapsed period of time since I think we've had on record. So Washington's going to do about it is on them, but I don't think that they're going to just allow it work its way out. I don't think that they have job security enough, the folks in DC do, if they were to just let this thing work its way out, regardless of whether you think that they should or not. I think you're going to see a lot more unemployment and benefits and things like that come in to help these people get back on their feet and help these jobs and help companies sort of reabsorbing the jobs that are there. That's my 2 cents.
Dan, you have anything different there or anything else you want to add?
To kind of dovetail that, I would say that I think, and I'm probably very optimistic on this, one of the main reasons why we've seen this major increase in unemployment is because a lot of these businesses just aren't open, right? They just haven't been open. And so these businesses are going to open back up. And so they're going to still need people to work there. And so there's going to be still jobs that's going to be available. So there'll be a lot of jobs that are going to be absorbed. My biggest fear is that the government is right now paying more money to people to stay at home and do nothing than to actually get out and work. And that's where my biggest problem is right now, where before usually you only get like, 2/3 of your pay or whatever, something like that. Where right now they're paying you like twice your pay to just, sit home and do nothing. So there's got to be a balance there to still motivate people to want to actually go to work. Because then you're going to have, if you don't, then you're going to have the problem of you have too many jobs, and then you have not enough people that actually want to go to work to actually fill those jobs, and that creates a whole other issue. But I think there's definitely businesses that are going to go under, or that have already gone under because of COVID-19, or at least they're going to blame it on COVID-19, but they were probably already on eggshells before they got into COVID-19, and COVID-19 really just kind of, crushed the entire business. And so those businesses probably should have already gone out to begin with, and it'll just drive that demand into a different area or to a different business that really should have had that additional revenue. So I think that there's going to still be a bounce back in the jobs, and I think that as long as they handle the unemployment properly, then they will continue to see that, because people in America still want to start a small business. And I was actually talking to a business broker just last week, and he said the demand for people buying a business right now has been going through the roof, because people have lost their jobs and they're like, well, instead of going to work for somebody else anymore, I want to go buy a business and start my own business again. So that's just going to continue to create even more jobs.
Yeah. And we're going to move kind of quick, guys. I want to make sure we get into as many of the questions as we can here. So I may ask either one or two at the most to answer a question. This one comes from Bree. Do you feel cap rates will change? Do you think they're going to compress or expand? Dan, I'll start with you, and then I want to get Tony's perspective as well.
Sure. I think in the short term, you're going to see an expansion very slightly of those cap rates. We've already started to see that right now. I don't think it's going to be significant. I think you're going to probably see about 30 to 50 basis point increase in those cap rates. And then I think over the next probably 6 to 12 months, it's going to start to go back to where it was before COVID. I don't think we're going to see a big 100, 200 basis increase.
Tony?
Yeah, so cap rate compression, it's happening to some extent, but we always have to look at it relative to the price of capital. And the interest rates remain low, and the spreads are actually increasing. So far, there's been enough downward movement or downward pressure on interest rates to keep cap rates more or less where they are. Now, we do believe rates will at some point start to rise, and that'll affect the cap rates. But back to the last thing, there was an affordable housing crisis here in the U.S. Prior to COVID, and that's not going anywhere. So the demand for apartment buildings remains strong. Unemployment, 36 million unemployment in a short period of time is going to take us time to dig out of that, right? It took us time to get there. It's going to take time to dig out of that. But I think that plays into another strength for multifamily, right? Now you can see which businesses, which jobs are COVID proof, right? And a property owner, you're looking at an application and say, wow, you nothing happened to your job during that time. And also it'll make some of these guys a little bit more skittish about purchasing a home, right? But they still need to live somewhere. So I think the garden style communities, the multifamily remains attractive asset class for that reason. And I don't think that the pandemic hurt multifamily. It's going to hurt multifamily demand. We were already 2 million short in supply, and you can't build them. You can't build them at a price where most people can afford to rent it. So that means the existing apartment communities are still going to be backfilled. You may have to look at 4 applications to find a great tenant where you used to look at 1.5. Okay, sucks to be you, but I think that we'll be fine.
All right, this next one here, primarily for Matt and Dan. How often do you look for rent slightly below market rent to keep units full and also to reduce turnover cost and vacancy? And if so, how much do you typically aim to stay slightly below that market? So when you're looking at market rents and your value add plan, where do you look at kind of that median or market rent, and how do you try to price your properties?
That's a great question. And I've heard that strategy of just charge less than markets and the tenants don't move out. I mean, it's interesting because I think a lot of your old tired owners or old boomer tired owners and whatnot, they've subscribed to that adage, which is how you end up with buying a property off of them, where they end up kind of letting it get away from them. And they're $150, $200 below market, right? So I think that I like to just be at market. I don't want to push market. I don't believe it, especially with COVID and a recession and like that. I don't want to push the market up, but I just want my properties to be leased at market. And there's lots of research tools you can use to determine that. But I do not believe in being too far, if anything, below market. I think that I've heard the adage that if you get a property that's 100% leased, that means the rents are too low. And I think that a good way to look at a property is to have a few vacancies, because that means you're right at market. It's interesting to look at things that way, but I think you're actually leaving money on the table. I'd rather just charge fair market rents and make it, because tenants don't want to move. Moving's a pain, man. They don't want to do that. Like, they'd rather just keep paying you what they can afford to pay you and what the guy on the street's charging versus moving out if you increase your rents $20. Now you try to increase it, $150, they'll move for that. But right at market, I think is a good, but you've got to have your finger on the pulse. So that's my advice.
Well, and I agree with you, Matt. And I think one of the things that you have to always be doing, which we require our property management companies to do this on a weekly basis, is they actually have to do a comp analysis every single week to see what is the competition doing. So are we at market right now, or has the market started to go back down and we need to adjust down as well to maintain that vacancy? So it's a constant, a stat that you have to have your property management company on it at all times to make sure that you can maintain that. And there's even software now that does a dynamic pricing, and even our properties, I think like half of our properties are on dynamic pricing, dynamic daily pricing. Just like when you go buy a plane ticket, they adjust the price of the plane ticket based on the demand drivers that are driving, filling up different planes. And so same thing with multifamily, you can do that same thing and have daily pricing so that it's actually constantly monitoring your competition to see if you need to go up or down.
Hey, this one's for Tony, and you may have this or not, but are you guys paying any attention to multi-generational households and shrinking households based on people looking to live together to save on housing costs and the impact this may have on rents?
That's a good question. The answer, I haven't looked at anything like that lately.
Matt, Dan, have you guys looked at that at all?
No, I haven't.
No, I haven't either.
Yeah, I think it's probably a good point. I do know a few folks who are focusing on that. In particular, I interviewed a guy who he's building brand new townhomes. It's urban townhomes where he is actually playing specifically for that. He's building like these 4 or 5 bedroom townhomes, and he's trying to get multi-generational families. Now, this is in high cost cities out there in California and whatnot, but he's building these townhomes and renting them for $4,500 a month, but he's getting like 6, 7 people to live in them. So that is something to keep an eye on. I think obviously if people are living in these urban cores, option A is move to the suburbs or someplace where it's a little bit lower cost to live. The other option is to shack up, right? Move back in with mom, which we obviously saw back in 2008, 2009 as well. And we're not sure how long-term or sustainable that would be, but that's definitely a good data point to keep an eye on. And we'll certainly make sure we look out for that going forward.
I will offer a comment on that because I've been studying how we're handling our aging population in the U.S., right? So if you look at not to go too down the rabbit hole, but if you look at the amount of COVID cases that have showed up in the U.S., an enormous percentage of them came from senior housing. Right. Because of the way that we take our seniors in America and just take them all and put them in a big box, and if one person gets sick in that box, it's very easily going to transfer to the other ones. So I think that we're going to see a shift in the way that we take care of our elderly and in our country. And multi-generational housing is a good idea if you've got, younger generations willing to have mom and dad move back in with them, especially if mom and dad have their own apartment or like an in-law, what they call an in-law suite or whatever. If you're able to create that, I think that you're going to see an influx of people that look for something in that nature, to get the folks maybe out of the nursing home or to take care of their folks and just have them under their wing versus putting them in a facility like that. And you've got younger generations that maybe through job losses or things like that aren't going to be able to afford, the 22-year-old that's fresh out of college might not be able to afford to get out there and live on their own. Maybe they can't find a job just yet. Maybe they're having to just take a job that's maybe below what their true pay grade is, just to make ends meet. Maybe they got to live with mom and dad. So I think that it's an interesting model, and I think that we're going to need more of it in America, but it's not something that we're doing. I think it is interesting though.
This next one is a yes or no, real quick question. Are you seeing any contraction in interest from passive investors who may want to sit on cash while things play out? So Matt and Dan, I'll ask you guys that first.
No. We talked about that earlier. I think that I would just replay them the first like 10 minutes of this webinar. When all of us really just counteracted that. But I think that right now is not a good time to be sitting on your hands. And I've had very few investors tell us that. I mean, it's more active investors that are hoping for blood in the streets that are sitting on their cash. Versus passive investors. I think passive investors are tired of Wall Street, to be honest, because Wall Street's been a roller coaster lately. So I think it's a easy enrollment to passive investors. We've actually seen more capital coming in from passive these days.
Yeah, you did such a great job explaining that yes or no answer.
Oh, thanks. I don't do yes or no. Sorry, it takes me 10 minutes to say yes or no. Sorry. Yeah.
Well, gentlemen, I know you have some more questions in here, but I'm gonna have to drop because I do have another meeting here right at 4 p.m. Eastern, my time here. But I would say yes, we have seen some, but it's been very few. So I'd probably say less than probably 5% have actually had that thought in our last project. But when we first went out with our project, we had maybe 6 people that after the bottom fell out that actually pulled out, and then like half of those came back in once they saw the true effects of what was happening, especially on the property. So it really wasn't a major impact. It did slow down their decision making in that process, but today, right now, I don't think it's as big of an issue.
Thank you, Dan. I appreciate your time. Thank you for joining us and sharing all your knowledge with us today.
Thank you, gentlemen. Appreciate it.
All right. Tony, Matt, if you guys have a few minutes, I'll try to get through these questions relatively quickly here. All right. This one's from Kyle. Do you think there may be a lag in rent collections due to the stimulus checks that went out? Residents were able to make this month's payment, but won't be able to make rents moving forward. What are your thoughts on that?
Too soon to say. It's too soon to say if there's going to be another stimulus round. It's too soon to say if they're going to extend unemployment. A lot of states that we invest in more, the Southeast, like, Kentucky, North Carolina, they're already going to, what do they call it? Like, phase 2 or, code yellow, whatever it is. So they're reopening in a lot of these states, which means there are folks going back to work in some of the states that we're in. So, but I do believe it's too soon to say truly on what long-term collections are going to look like, meaning like July, August, that kind of thing.
Yeah, I'd agree. I think that we're not going to know that until all those funding sources run out, which is probably another 3 to 6 months out.
And how soon we open up, we open back up. And as we watch states that have already opened, like Florida and Georgia and those folks, to see if they have real significant spikes in COVID, not like a day or two spike. I'm talking about like week-long, 3-week-long spikes to determine if it's safe to open back up. They're kind of the canary in the coal mine. And if they don't, and I'm hoping and praying that they don't, because that means that the rest of us can start to do the same. But I'm hoping that we open versus the government just keep on pumping out money. I'm hoping that things just start to, reopen and folks start rehiring and we start to heal.
Yep. There are a couple questions. Go ahead, Tony.
I just wanted to say I want a mic like Matt's.
This is my wife's. My wife's got her own podcast for the Invest Her Show. So this is my mic-in-law here. Right? Yeah.
There you go. Yeah. All right, I'm gonna go through a couple of these questions fairly quickly because I think we've covered some of them, but I think we get through at least 3 more. The first one here: how do you think this will affect buildings in the 20 to 50 unit size? I'll answer this one. As Matt mentioned, I think that 20 to 50 unit size, that's where you get a lot of mom and pop owners. I think that may be a really great opportunity for investors if you're doing any kind of cold call or direct to seller outreach. Those are the kind of things you want to do where you may be able to get some great value. Obviously, you could talk to brokers and go that route as well, but some of these owners may be burned out and that may be your best opportunity. So I do think there may be some opportunities in that 20 to 50 unit space.
I agree.
Next one here. When underwriting, are you increasing loss to lease, concessions, and bad debt? How much are you allowing for vacancy? I know we are doing that. You answered this a little bit earlier, Matt, that you are doing that as well. As far as how much, I think you've got to factor in a lot of different things. You have to understand the asset. You have to understand the historicals. You have to understand the vacancy, your business plan. But definitely increase those things and give yourselves a little flexibility if you want to be conservative. You got anything?
It's going to look at the jobs in the local market. Look at where people are working in the market that you're investing in.
Yep.
Yeah, we're also asking a little bit more questions earlier in the due diligence cycle. Like we want to see applications. We want to kind of figure out where people work and how they weather in the storm. We're also looking more at collections, to kind of see how they, not only did you get all of April or May, how did they come in, things like that.
Last question for the guys. This one I would love to get both of your opinions on. So it says here, on new acquisitions, are you still looking to maximize leverage? Or are you now looking at lowered LTV loan-to-value options from financial institutions? Tony, you're working with a lot of investors, obviously, and talking to a lot of lenders. Are you seeing a shift or a change in the way they're looking at their leverage on these deals?
Yeah, the lenders are, I mean, you can still get great debt. They're really moving toward experience of the team and things like that. But there's great debt out there. There's great leverage. But we are looking at a little bit more of a reserve because we're in the middle of something that we need to know that those landlords or property owners that didn't pay, you didn't have 2 weeks reserves because of the first part of this, it was just 2 weeks. Right. So we want to make sure that there's adequate reserves there to be able to weather a storm, even if there is another wave. Yes, the lenders are pulling back a little bit on what they're allowing as far as LTVs. And in any cycle, that's been a driver. If you're the guys that were low leverage, they made it. The guys that couldn't take a vacancy here or there are the guys that lost their shirts.
Matt, how are you adjusting your leverage approach?
I think that we're looking at, instead of 80% LTV and things like that on new purchases or on refis and stuff like that, we're looking more. I'm not doing more like the Sam Zell model. I heard he's at 55% LTV. God bless him. Right. So we're looking at lower rates, more like 70, 75. And that just, I agree with Tony that I think that you got to have a little bit of room for bumps in the road and everything like that. But I also think that you can accomplish that with some cash reserves and with other mediums, but I don't believe in levering properties all the way up right now, given where we are, given that, the folks that I respect are talking about a recession after this thing's over, that it should last another a year and a half, 2 years, somewhere in there. I wouldn't want to be going into a recession at 80% leverage.
All right. Appreciate it, Matt. Thank you for that insight. Tony, you guys have been great. I appreciate you sticking around a little bit longer just to answer some more questions from all of the audience members. And thank you. For those who are checking this out, appreciate you spending that time with us. If you've enjoyed this, please let us know. We appreciate that feedback. The full recording will be available. We'll make sure we send that out. And we are doing another one of these in 2 weeks on economics and the current state of the economy. And we've got a phenomenal lineup there with Kathy Fetke, Neil Bawa, and Jay Scott. So you definitely want to make sure you check that one out. We'll make sure we send out the registration link for that as well. Thank you again. You all take care.